Now, when it comes to the stock market, first of all, it's important to mention that up until now, we have seen one of the strongest 6-month rallies ever in history. And from my perspective, the market was going up so much to the point where investors were starting to get nervous about whether or not these types of gains were sustainable. For example, I've said this before, but last week, search volume for AI bubble had just broken a new record. Investors believed that the economy was on borrowed time. And the billionaire Paul Tudor Jones said that this is reminiscent of exactly what happened right before the 2001 dot-com crash. On top of that, while all of this was going on, credit scores were dropping at the fastest pace since the Great Recession. Private credit was drying up. And even anecdotally, I've started seeing a lot of investors pulling back on their investments, keeping some cash on the sidelines, and piling up some dry powder just in the event we see a market sell-off. Even for myself, I do my best to dollar cost average into the markets on a regular basis, and it's been harder and harder for me to justify some of these recent valuations. Like, just consider that tech now makes up more of the S&P 500 than the peak of the 2001 dot-com bubble. The top 10 companies now make up more than 40% of the entire index, and the Buffett indicator just recently hit its highest level ever recorded, implying that this is one of the most expensive stock markets according to his data. I say all of this because, from my perspective, no charts, no data, just my own observation, the stock market appeared to be operating on borrowed time, just waiting for a reason to begin selling off. And this was the catalyst that caused people to hit the eject button, especially when we hadn't seen a 2% decline in more than 6 months.